Good afternoon, everyone, and welcome to the launch of Innovate Finance's H1 Investment Landscape Report. I'm Janine Hirt, CEO at Innovate Finance, and it is a really exciting day to be hosting this webinar. We have released our numbers in terms of investment globally into FinTech and also here in the UK. But in addition to this, last night at the Mansion House dinner, there was a momentous occasion happening in that the Mansion House Compact was signed, which is an agreement between 9 of the UK's largest defined contribution pension providers, committing them to the objective of allocating 5% of assets in their default funds to unlisted equities by 2030. So it's a great time to be looking at investment into FinTech. I have with me today Mike Carter, our Senior Policy Advisor here at Innovate Finance, Veronica Glab, our Head of Partnerships and our Investment Lead here at Innovate Finance, who will walk you through in a few moments the detail and the data behind our investment report. And we're also joined by Erik Mostenicky, Principal at Fidelity International Strategic Ventures. And in a few minutes, we will also be joined by Simi Shah from the City of London. So Erik, thank you very much for joining us as well. I am going to hand it over now to Mike, who has really led a lot of the work that we've also done in the City of London in the early stages around the growth capital piece and the announcement that came from the Lord Mayor last night, who will lead the discussion with Veronica and go in depth into our report. And then Erik will bring you in and Simi when she joins to look at some of these key trends and key themes. So I would add, please, anyone that is interested in asking a question, please do put them throughout the conversation and the team will either address throughout the discussion or at the end as well. And this will be recorded and people can revisit this at a later date. So thank you everyone for joining us, and Mike, over to you.
Thank you, Janine. So welcome everyone. Thank you for joining us this afternoon. For those of our members on the call, you'll be aware that we publish every 6 months reports on capital invested into FinTech, both globally and in the UK. And as Janine said yesterday, we published the report for the first 6 months of this year. The trend has continued to be down, which is the trend we saw at the end of last year, but there are quite a few other aspects of the capital performance in the first half that we're going to discuss. And then we'll get the investor's eye view from Erik when we've done that.
A quick view at global FinTech investment divided by half years. So we tend to look at the investment landscape, retrospectively in the year as a whole, but we also look at half years and by quarter as well in our more longitudinal assessments. And as you can see, it's been a rough year for FinTech. FinTech globally, investment across all stages of VC has dropped pretty significantly since half year of 2022. Now, a couple of things to remember about FinTech investment overall is it follows a similar sort of wave-shaped cyclical pattern to actively all other capital markets, which means that FinTech is no less risky significantly than other industries. But what we have seen is that 2021 and 2022 were pretty outsized years for investments. So last year, we started to see the early signs of a recession when investment fell flat on the previous year. And we started speaking with a lot of our investment community to see when they were expecting a recession to begin. And so we started seeing those signs towards the end in Q4 of 2022, when investment really began to drop pretty quickly and significantly. And so far in the first half of this year, it's remained almost at the same level as the second half of last. So a couple of things to keep in mind there is that, yes, while investment has dropped pretty significantly from this time last year or from the outsized results of 2021, it's actually stayed almost flat on the second half of last year. And we can go a little bit more into the patterns that have emerged from there on. Can we move to the next slide? All right, so across global FinTech markets, we also assessed which were the top 10 performing markets around the world. And no surprise, US followed by UK, number 1 and number 2, and quite ahead of all other global markets. Now, what's important to remember is that while investment into both US fintech and UK fintech has also dropped significantly in terms of percentage, both the US and UK remain very far ahead of the remaining 8 markets in the top 10. 2 other things to point out, quite interestingly. There's been a bit of a paradigm shift in the global fintech heat map. So 2023 so far has been the first year where 4 out of the top 10 are Asian markets. So 3 of those being APAC, South Korea, Singapore, and China. And I think China will be an interesting one to watch as well. Every time that we've done the investment report, China comes dramatically quite in and out of the top 10. It can be number 10 one year, it can be number 20 the next. So that will be definitely one market to watch throughout the rest of the year, probably into the next 2. But Singapore and South Korea have actually now for 2 6-month periods made the top 10. So definitely gives an indicator of their stability as a market, as well as the local appetite to engage with the international investment community. And this is just the pure numbers here from that first graph that I had showed, but zeroing specifically in on the UK. So globally, we've had $27.3 billion US invested in into fintech. And as I said previously, this isn't that big of a drop from the second half of 2022, when we did see a radical drop from July onward. And the UK sector in particular has seen $2.9 billion in investment. That unfortunately is a 37% drop from the second half of that year. But as we've done also more longitudinal assessments of, say, the US and the UK market, what we've also noticed at Innovate Finance is that the UK tends to follow a little bit behind the US in terms of major macroeconomic patterns. So this time last year, the US had seen, I think it was over a 50% drop into investment into American fintech, whereas the UK had remained almost flat. Now the UK is seeing that significant drop, while the US is starting to see early indicators of macroeconomic stability, if not recovery. So we do actually expect the UK to start following in step with American patterns towards recovery quite soon as well.
Yeah, so the US is actually up this half on the previous half, partly by dint of the big Stripe deal that took place in the first half. If you took the Stripe deal out, the US would be down, but it's a real deal. So the US is up, and as Veronica said, the US is often a leading indicator in economics and markets, and so we're looking at that with interest.
Yeah. And it's just a quick overview of UK specifically into a 5-year. So what we've seen is UK fintech grow pretty steadily. But as you can see, 2021 and 2022 have been outsized years for investment. So occasionally a little bit of an unfair comparison. The first half of 2022 in particular for the UK was just an absolutely massive year, also in part to some incredible mega deals that were taking place. In 2022, we had over 33 mega deals in the UK. So those are deals over $100 million. And that definitely brought the average up by quite a lot. But we still see, and we will go into this later on, but we do still see continued indicators of the resilience of the sector here.
What's interesting, if you look at this chart, is comparing the first half of this year to the second half of 2019, first half of 2019, so the pre-COVID years. Obviously, those were periods of low economic growth, but we had very low interest rates, we had low inflation. It was quite a different economic environment, not nearly as difficult as the one we found in the first half of this year. But we've still had as much or slightly more investment in the first half of this year than we did in those particular halves. So I think that is a positive indicator about the state of the market, that we're still getting more investment despite a really, really difficult market.
Yeah. And even further to that, when we actually calculated the average deal size, so just taking the amount of capital invested in dollars, divided that by the number of deals taking place in a given market. In the UK, in 2019, 2020, and into 2021, the average deal size across the whole landscape was approximately $12 million, whereas it sits quite comfortably at $15.5 million for this year. So that's one of those indicators of sector resilience that we've seen, because it does go to show that there is investor confidence. While investors are being quite selective in where they're deploying capital, they are very confident when they do.
So we asked some of our VC members in January what they expected would happen in the first 6 months of this year. What has happened, does that tie with what they expected?
Yeah, I mean, we've been pretty consistent in broad strokes. Our members in the VC community have started warning about a recession as soon as the very end of the first half of 2022. So what we have found has been actually pretty consistent is that we've been warned of a recession coming, and a recession, hyperinflation has indeed arrived. Where we've seen just a little bit of a difference is in that time frame. So I think initially a lot of investors in summer of last year were fairly confident that by the second half of this year, or by so Q3, Q4, we would start to see economic recovery. That hasn't happened yet in terms of any sort of big sweeping indicators. And that's also because of some of the timeframes of more macro and regulatory events. So, for example, the US, we are waiting for the Fed to make key announcements on, the interest rates. We were also very carefully watching the levels of the national deficit in the US. And as some of those timelines have moved in that sort of short term, investor expectations have moved as well. So while we had initially predicted that in the first quarter of this year, there would be a spike in investment activity, and we were correct that the first quarter was very, very active compared to Q2. We didn't see any, rising levels. We did still see a drop. But of the VCs that I have spoken to as well, they are confident in their longer term view that by 2024, we will start to see those indicators of recovery. That's been pretty unanimous, is that 2023 would be a difficult year. It would be a slog, and we're in the middle of it.
And what sectors are we seeing investments in this year so far?
So broadly, B2B FinTech is very exciting for investors, with the underlying proposition that products that make businesses more efficient. If you're making easier the life of a COO or CFO and making their operations more efficient, their financial decision making better, then that ultimately helps a company to scale, grow, and sustainably develop. Across particular verticals, what we've also seen is financial infrastructure, the kind of unsexy fintech, but the ones that really underpin the functioning of a business. So we still see a lot of excitement into open banking and APIs. Crypto, I think, depends who you ask. There's kind of split opinion across investors there, but investors are now also getting very excited about artificial intelligence, also as being one of those B2B products where it can make a business's operations more intelligent, more efficient, and more conducive to sustainably scaling a company.
Okay, and we also report every 6 months on investment into female-led fintech businesses. What was the results in the first half of this year?
Unfortunately, this year, of a sample size of deals that we've looked at in the UK, female-founded fintechs represent only 2.2% of all investment into UK fintech. That is a significant drop from 5.5%, which is what we saw in January, looking at the entirety of 2022, and previous years where the average for the last 3 years has sat at about 9 or 10%. So that is definitely one of the more disappointing findings from this report.
So as investment has fallen, it's fallen faster in female business.
Yeah, and I think part of that, having spoken with the investment community, is it's not so much based on any innate discrimination, but just the general selectiveness of where investors are going to be more confident. Some have certainly chosen to allocate capital into businesses founded by serial entrepreneurs, where they've had that proven experience, or looking into particular highly regulated fintech verticals where a lot of the founders are also largely male themselves. So it's certainly a number of factors. What I have seen that is encouraging is a number of VCs that are working at the ground level, almost at the incubator level, to not just take accountability for diversifying their own portfolios, but to actually create networks and incubators to support female entrepreneurs in getting in front of an investor audience and in their own investor readiness as well. That will probably have more like medium to long-term results. So I am at least optimistic that we'll see higher figures next year.
Great. Thanks very much, Veronica, for taking us through the numbers. And you'll find all of those details on our website, plus the charts. We're now going to switch from the data to the real investor, to Erik. Erik, first of all, just reintroduce yourself if you can for the people who got on the call, and then we'll go into some questions.
Very, very happy to, Mike. So thanks for having me. Erik Mostenicky, part of the Fidelity International Ventures team, a principal here for the last 5 years. Focus on investments into wealth, asset management, capital markets, as well as the underpinning enterprise software, and primarily from Series A onwards. So the early growth stage is the sweet spot for us, but we tend to focus on things that are slightly early and slightly later as well when it comes to tracking within our niche. So that's roughly the intro.
Great, thanks, Erik. Well, let's kick off. As Veronica said, the first half was down again on the second half of last year, both in the UK and globally. Is that consistent with what you experienced and what you saw in the first half?
I mean, definitely, if you look at the aggregate and you break down the numbers, 2021 was the crazy year. That's when it culminated into massive fear. And that has slipped into 2022 when deals were actually closed in 21, but they got announced later. So you have a bit of a slippage there for sure in a natural cause. I think when I kind of remember back to the sentiment in the market already towards the end of 21, there were signals from the public market side and interest rates environment that, things ahead are not going to go in the way people were hoping. And you've seen a massive downturn on the valuation side across the growth companies. So that has then taken a bit of time to culminate into the early stages of fundings. And I think the sentiment in H1, and I would expect in H2 as well, is not going to be much greater, right? If you think about both the retail investors as well as people on the street, in particular in the UK, let's take that as an example. We can go back to your comment around US being the forecasting force for the other markets. Institutional investors are bothered about the performance of the public markets, and they're rethinking the allocation strategy when it comes to interest rates. Where do you get more bang for buck with the amount of risk they're underwriting? And currently, the venture landscape is going through a bit of a transformation. So we think that the numbers are reflective of that, and in particular, fintech as well. Wealth asset management has been historically a little bit less exposed in comparison to payments, but those are some of the markets that we anticipate will see quite a bit of evolution going forward as well. If I think about what has transpired across the rounds, there's a lot of founders who started new businesses, so there's still a lot of excitement, a lot of stealth companies that have been started from big software companies, but there's also a lot of internal rounds because people didn't convert their business models to the extent where they could attract, very attractive rounds. So yeah, it's a choppy market, and I'm hoping that through a bit of consolidation and a bit of forthcoming, we're going to see the light at the end.
So you talk, Erik, about evaluations. They were high previously and they've been coming down. Do you think the valuations have come down far enough for investors to start re-engaging?
Yeah, the short answer is yes. The long answer is depends which stage and what kind of company. At the early stage, you mentioned female founders and serial entrepreneurs. Serial entrepreneurs are just getting way different pricing to someone who doesn't have the connectivity and the track record, right? So that answer really depends. When it comes to the more growthy end of the curve, there's a lot more heritage and benchmarking towards the public market side, which is more realistic because the risk towards pricing a premium is spread over a shorter period of time. So there's a more realistic, I would say, market situation right now. You can see it in the number of deals done as well. But at the earlier stage of the market, I think it's been a little bit more, I would steady. And less deals getting done, but the prices are, in comparison to 21, good, but not to the extent we're in the previous levels. So I would expect there's going to be still a little bit more price pressure to come across both the early stages as well as potentially later stages. But again, all of that is subject to the evolution on the public market side, to the interest rates, to our Bank of England or the central banks in other regions, and how they're going to influence our economy.
So we've got, certainly in the UK, we've still got rate rises potentially out there. We've got inflation taking longer to come down and quite a few other uncertainties. What needs to happen for investors to feel that the time is right to start reinvesting?
I think investors are investing, and there's still a lot of dry powder in the market. But I think there's, let's say, more cautiousness and more awareness across both junior and senior investment professionals around the sentiment in the market. And also, the word on the street makes an impact on people's perception, right? So I think it is very vital that the economy starts to recover, because it will create a bit more of a healthy push towards people thinking about investments overall. But I think in the venture capital space in particular, we just have to keep on cultivating talent and encouraging founders and new founders to come to start new companies. So having access to early stage capital as well as the follow-on capital, and the follow-on capital, especially in the growth stage, which links up to your early comments around the pension funds enablement to allocate capital, is a crucial gap in the European market, which is one of the reasons why a lot of these companies tend to flock into the US or attract US capital to get really to the next stage of IPO readiness.
Okay, so gazing into your crystal ball, Erik, when do you think we'll start to see investment properly turning up rather than just sort of bouncing along the bottom where we are?
I think it's going to be interesting to observe what's going to happen in the next quarter on the interest rate side, right? The recession and its effects are still not disappearing, I would say, and the pressure on living, in particular in the UK and European markets. So I don't expect huge transformations, both in terms of investor sentiment nor demand over the next couple of quarters, but hopefully 2024 will be a more encouraging year. But again, a lot of things might turn, and it is unfortunately at a stage in the market right now where we are depending on something that hasn't been around for a long period of time. I mean, the interest rate environment at this level wasn't here before the global financial crisis. And a lot of investors who have flocked into the venture capital community haven't experienced the global financial crisis as a part of their professional careers. So I think there's been a lot of adjustment in the industry that has gone and is settling in slowly.
Okay, so we'll proceed with caution for the next 6 months, and hopefully the macro environment will get to a point by the end of the year where there can be more general confidence by the sound of it.
I'll also add to that, because Erik made a really good point about the cost of living crisis. And actually, I wish I'd remembered to mention this before, but one of the areas of FinTech investment that's also interesting to investors is products and services that are helping with debt solution, cost of living management, and even wealth creation and wealth building, or rather the democratizing thereof, which also just goes to show that while we're working in a challenging environment, necessity is the mother of invention.
100% agree. There are certain themes that are more attractive in the current setting, and there's some that are less so. You know, the pressures around consumer fintech are here. Like if you think about 2021, there has been a lot of interesting ideas at the early stage of the funding cycle, where now we see a lot of M&A activity because for different reasons. Number one, the traction hasn't been that good. Number two, perhaps the business model initially wasn't that good. Number three, the market has turned and people don't have that much capital to allocate, for example, for new consumer-focused investment solutions. There's different reasons, but overall, more to come, especially in the new area, aligning around interest rate environments that I think is quite interesting. We can go more into that later on.
Great. Well, Erik, thank you very much for joining us this afternoon. That was really great to get your expert input on what you see is happening in the market. And we're now going to turn to the second part of our webinar, and we're delighted to be joined by Simi Shah, who Janine mentioned at the top of the call. Simi is from City London Corporation, and we're going to talk about the very exciting announcement that took place last night at Mansion House regarding DC pensions and how they're going to start investing in growth assets. So Simi, welcome to the call. Give us a little background intro to yourself if you can, and then we'll kick off.
Yes, no problem. Hello, everyone. Simi Shah, I'm the Director of Innovation and Growth at the City of London Corporation. We work on global competitiveness in 3 areas: open and global, innovation and technology, and sustainable finance. And I also lead the innovation and tech work and enjoy working with colleagues at Innovate Finance on many of those outcomes.
Great, well, thanks, Simi. So back in April at IFGS, we had a panel on powerful pensions, and you told us there that there's a lot of work going on behind the scenes to get DC pensions mobilised, and that actually seems to happen much more, or the announcement seems to happen much more quickly than anyone expected. So tell us what was signed. And what
Do you remember the last
night?
question you asked me on that panel?
Well, what was that? How long will anything happen this year? Is that what I asked you?
You said, how long do we have to wait? And I said, you don't have to wait until the end of the year. I was being a little bit conservative. Now I can take the summer off. Yeah. Anyways, in all seriousness, you'll have seen the news. Several things were announced at Mansion House last night, but I think we're here to talk about the compact, which I'll talk about what it is in a minute. But the 2 main objectives, the primary objectives, is to give UK savers better access to investing in high growth companies so that they can benefit from the growth that comes from UK high growth companies and the work of entrepreneurs. And so that's the primary objective. The secondary objective is to channel money to those companies so that they can indeed grow and create jobs and wealth creation for those involved in those projects, and then the savers who are investing in them can also benefit. The compact is a voluntary agreement between 9 signatories, and these are what we call founding signatories. So we are hoping that more institutional investors come on to make the same commitment. But what it is it's again a voluntary commitment between a group of institutional investors to achieve a minimum 5% allocation to unlisted equities. And all of these institutional investors have made this commitment with DC, defined contribution, workplace pensions, and other sources of long-term savings. And this signals a bold ambition to unlock about £50 billion of capital by 2030. And this figure is derived from the anticipated value of workplace DC pensions by 2030. The founding signatories who were announced last night and who were with us are Aviva, Scottish Widows, Legal & General, Aegon, Phoenix, Nest, Mercer, M&G, and Smart Pensions. So they represent about 400 billion in assets and around 2/3 of the entire DC workplace market. They came together and they've been working on this quite diligently since our Powerful Pensions report, which Innovate Finance and us published with EY in March. And they've been working together to do this collective action that we talked about in that report. As I said, this could unlock about 50 billion pounds of investment, and the math takes us to increasing pension pots to about 12%, which represents about 16,000 for the average earner over the lifetime of their pension. That's what we're projecting the uplift as.
So it's a voluntary commitment. It's not the government mandating the 5%.
That's right. Yes. Yeah.
And is there anything the government needs to do in terms of legislation to help this happen, or can it all be done by the pensions industry?
Well, it's interesting. So one of the things that we worked with the Treasury team on this and with our industry groups is trying to elucidate what actually needs to happen. There are probably a few regulatory things that can be done, but primarily this is about the government issuing guidance and working with the regulators to talk about some of the changes that need to happen in industry practice. The very biggest one, of course, is around and this is again some of guidance and some of practice around not presenting pensions and pension providers with cost, but rather thinking about long-term value. And that has a huge value chain, as our listeners will know. Everyone from investment advisors to employers to scheme members themselves have to understand what that means and not make choices around cost, which leads to very different outcomes than thinking about the long-term pension of your value, long-term value of your pensions.
So instead of saying to the members, we've got the costs as low as we can possibly drive them, they should be saying to the members, we think we've got the best returns on after costs, and changing that mindset.
Yes, and one of the traditional barriers to having more of people's pensions going into unlisted equities is that it costs more to invest in that way. And while that's true, if the value of your investment goes up and the costs then become part of just an equation, right, which is a long-term calculation, which you should be doing with your pensions because they are a long-term asset, rather than only a cost decision, which of course is a short-term asset. So
does this mean there's going to be one big new fund into which all the DC money will flow, or will there be lots of different funds set up, or do we know how that's going to work yet?
That I don't have a crystal ball on. But so as you remember, Mike, in our report, we talked about the helpfulness, the value of having collective actions. So pension funds pooling their funds together, whether that be in a fund structure or a pooled structure like we have in some of the local pensions. But there is value in having a larger fund, which can have scale and size and de-risk. That's the other traditional kind of barrier to people thinking about unlisted equities. There's too much risk. But if you have a bit more of a sizable fund, you can get around that. But the compact doesn't say we have to have a big fund. That would have to be a market response. And I know that there are some people working on that out there. But the compact doesn't commit the signers to investing in a certain way. They can use any vehicle they like. And there probably are ones. That's a great part about creating demand, right? Is now that we have demand from institutional investors, the market should respond with lots of different kinds of product. And we welcome them all, because that, as we've said, has always been our North Star from Khalifa from 2021, right? Is that we need to up investment levels. Yeah. And that will happen and should happen in a variety of vehicles.
But the signatories to the compact, they're confident that a fund can be structured, though, in terms of things like liquidity and reporting and all those kind of things that you need for a DC fund.
And those are investment level decisions that they'll have to make, and they'll each make different ones. Yeah.
Yeah. Okay. No, that's great. And what asset class is the money potentially going to flow into?
Yes. So what we say in the actual compact is venture, private equity, and other unlisted equities. So you will remember, or the audience may know that there are companies that get listed on AIM and ACRIS, which are technically considered unlisted. And so the compact covers venture, private equity, and new entrants onto something like an AIM or ACRIS.
Okay, so all the way through to that early stage listing, if you like.
Yeah, probably secondary investment into those smaller exchanges probably doesn't count in the spirit of the law, but yeah, new money to true high growth asset classes is what we're after.
And would you expect it to be a fund-of-fund kind of structures rather than DC funds investing directly into specific managers' funds?
In the main, yes, but again, it's not mandated well, nothing is mandated, the compact, it's voluntary, but it's not set out which vehicles people need to use.
Okay.
They could do direct, could take a direct investment route.
Right, okay. So I mean, so far so good in terms of what was announced last night. So what happens next, Simi?
Yes. So again, as I said, it's recognized that the organizations that have signed up to the compact will be at different stages. So they'll now start their exploration of how much, when, with what vehicle they want to move into unlisted equities. And again, this is kind of a longer term view, right? And they'll need to do different profiling for different parts of their demographic of their clients. But they'll move towards those actions now. And we intend to get together at Mansion House next year with a sort of year on what has taken place in terms of structures, funds, capital flowing, and the corporation together with Innovate Finance will be watching that very closely, and we'll take responsibility for reporting out where we've got to. The other thing that we need to do is try to entice additional institutional investors to join the compact. So we wanted to get a big part of the market on for this initial signing, which we've done, but it's open and we're hoping it's attractive to the rest of the market. So we'll be working with additional signers. And the other thing that I think needs to happen is, you asked me about, what does the role for the government here in terms of some of the items that will show up in the autumn statement. So we'll be working with the Treasury team on that, and working to convene the various bits of the value chain that I talked about before that need to either get on a journey with some of the things that need to happen, or need assistance, or need new guidance. And also the regulators will be at the table for those discussions. So we need to convene the value chain. Now, I said to someone last night felt a bit like a wedding. Now we need to have the marriage.
So in terms of when money might actually flow, we're 12 months away or something like that, aren't we?
New money as a result of the compact, I can't say, Mike, because as I said, each of the institutional investors will have to do based on their kind of savers profile. But I would expect seeing money flowing before we get to Mansion House next year, of course. Okay,
that's really great. That'd be excellent. And has the government said that they're going to make some further statements around this in the autumn statement? Is that right? So are there going to be some further updates then?
Yes. So the whole industry, not just the ones who have signed, will get into consultation with the Treasury about exactly what we need to see in the autumn statement to help accelerate the signers' action.
So in terms of the pieces needed to make this happen, then it sounds like everything's in place. The industry have signed up, government are supportive. The work has been done, a lot of it in the past with the Productive Finance Working Group, in terms of looking at the issues around the structures. So it's really up to the industry to take it forward now, is that right? Yes,
and for us to create lots of companies that they can invest in.
That's great. So Susan, you're going to be monitoring and managing this over the coming year to make sure it stays on track. And you say you're going to be reporting back in 12 months to let everyone know where it's got to. Is that right?
Yes, that's right. And we, as I said, we hope to do something formal at next year's Mansion House, but you'll be hearing from us throughout the year about ways to get involved. And we'll be, as I said, attracting new signers. So you might see announcements as different signers and different initiatives come online.
Okay, that's great. Well, congratulations to me. I think it's a fantastic achievement to have got it signed last night. I know when we talked about this last year, we thought this was a very long-term project to get everybody to the right place, but it seems to have happened much more quickly than anyone imagined. So it's a great outcome, and I think helped in no small part by the Lord Mayor's initiative around the Growth Fund, which very much coincided with the same thinking that you had around how growth capital should be enhanced.
Yes, and I should say thank you to Innovate Finance and your team, because I think it really speaks to the role that both of our organizations can play, right? There was some dark moments last summer when people said you couldn't do this and it was too big a ship to turn, and that there were too many barriers, sort of either culturally or legislatively or what have you. But it's a really special time when sort of industry, treasury, and organizations like ours can kind of push out of those dark moments into what we saw. And I don't mean to be too dramatic, but really big thank you to you, Mike, and the team for working with us on this and walking the journey.
Great. Well, Simi, thank you very much for coming on this afternoon straight away after the announcement last night. It's great to hear it directly straight after signing, so everyone on the call can hear the full details. So thank you very much for joining us. Erik, thank you again for joining us. We've heard that the first half of the year in terms of investment was down again. No surprise given the economic climate. I think the second half is going to be flat at best.
Well, I don't know. We've got Erik in the room. He's the expert. What do you think?
Erik's giving us hope for starting 2024.
We're still working hard. No, you don't worry.
And Simi is generating the money to come on stream in 2024 as well. So the outlook, I would say, is positive, even if the last 6 months have been rather negative. So thank you very much, Erik and Simi, for joining us, and thank you all for joining us on the call today.
Great.